So we have an ICT bullish breaker here, but I want you to think about how the market from this high traded down and then traded up and then through it. What does that make this range from this low to that high? Once we broke out above this high here, which is what we were anticipating, this becomes a balanced price range. What makes it balanced? We had a high, we traded it down. So sell side delivery has been offered, not sell side liquidity. Sell side delivery is any price run from a high to a low. We have had sell side delivery from here and here, that range. Now, when we run right back over that entire range again, from that low up to that high, which is what we're doing here over time, as soon as we break through it here, this high to that low is now a balanced price range. There is absolutely no reason to anticipate, expect, or want to see price come back down below that low. Why? Because the focus is up here. So where is the mile markers at going to be? Where's the rest stops along the way? Well, when the market runs above this area here, it's more likely to do what? Treat this level here as a breaker or a springboard to go higher. Why? Because this high has a lower low that's higher than this low over here. So the market comes back down. Does it wick through that high? Absolutely. And that's permissible. Look where the bodies close right here and it opens right there. So there are wicks that are going down into this buy side imbalance, sell side efficiency, which is a BISI. It's a fair value gap, but what specifically stands out here? What is that? What's the segment between this high on that candlestick right there to this candlestick's high? What is this area? It's inefficient. But then when we see this candlestick here trade down into it, it erodes some of this inefficiency. So it starts from here to here. This becomes a breakaway gap. We don't want to see that filled in. Are you telling me the ICT is teaching how to see, anticipate, and work with breakaway gaps? Yes. So we have this area here as a breakaway gap. Why should it stay open? Because it's running out of this range right here. It's already done the work of digging into this daily propulsion block. So I'm going to watch price. I want to see periods where it's going to run aggressively higher. If I get that, then I'm going to be really trustworthy that I'm on side. That means I'm on the right side of the marketplace and stay with the idea. Do we get that confirmation with the body staying at or above this high here? Yes. So the market should be rallying higher. Where should it go? Well, where's the next draw on liquidity? Near term. Yes, this is it up here, but what above this high exists in terms of liquidity? Buy side. So the market right here has buy side. The market draws up into it. What happens before it gets to this run right here? You see this wick right here? Half of that is what? Consequent encroachment. Interesting how it goes right down to it right there. Interesting how we have a gap right there with a wick. So if we have a gap like this with a wick, always trust and allow for it's likely to go into this consequent encroachment, not just fill in that gap right there. So it can trade down, even though it goes over top that gap, the candlestick's high right here. If it went through that live, I would not be unsettled by that. I would look for this candlestick's wick right here, the midpoint, which is consequent encroachment. We treat that as a gap. The market goes right back to it there. Then what does it do? Right back up here. All right, so when the next candle opens up, I would be looking at that and saying, okay, now I want to see it start expanding towards this high here. And I want to see it aggressively run through it. I want to see speed. Well, we get it there. We come back down in. What is it doing? It's working inside this wick, which is what? A gap. We do gradients on wicks. We never want to see, in this case here, lower than 50% or consequent encroachment. So any respect of this wick should be limited to the high, 75% of the wick, and then consequent encroachment, which is half. Go over here, look what it's doing. It's going down, but it won't breach on a closing basis midpoint of that wick. So the market does what? It rallies above this high here. What's above that high? Buy side. Someone is chasing that lower when it's creating that. This is an hourly chart. So inside that weakness in that hourly candlestick, someone's going short. Where they're going to place a stop? Right above that high. So the market does what? It gravitates up to it here, and we drop down, respecting consequent encroachment there, and we rally. What do we do now? We start expanding aggressively towards that weekly mitigation block, and we trade up into that level there, and then we consolidate. Markets do not top like this. So we have, what is this? What does this area right here become? Once we trade through it here, the same thing I told you this becomes, a balanced price range. From this candlestick's high here, up to this high, then back down. Once we clear this high here, this whole shaded area becomes a balanced price range. I am not concerned about price wanting to, at any time up here, going back down inside this range. So for stop loss management, your stop loss can be anywhere in this range and feel pretty confident that it's not going to get there. So how would I do it and sleep good at night? 75% of that range, if If my stop is below that, I'm comfortable with that. We have the market rally aggressively here, which is a buy side imbalance, sell side inefficiency, which is the long name for BISI, B-I-S-I. But I want you to think about what is occurring here. At this time of day, at 10:30, after the news driver, we have this swing low here, and it breaks below that. This segment of price action right in here is a fair value gap. So we would anticipate markets like this to reprice up into this candlestick or higher, and then reprice lower. Why? What time of day is it? New York lunch macro. So above this high, we have buy side liquidity, and it's entering the time of day where the lunch macro, which is going to do what? It's going to run for liquidity. Where is the liquidity at for this time of day? It's below the lows of the morning right here. This is your swing low right after the news driver hits the marketplace. Everybody that went long or was long before this market report was out, they have their sell stop resting right below that. That's exactly what the lunch macro will do. It'll run from this fair value gap here, drop down aggressively, leaving what? Most of this portion of this open. So we're seeing even on the 5-minute chart, look at the bodies of these candles here. Are they closing below that breaker line, which is this candlestick's high right there? Even on the 5-minute chart, it's showing you what? That this is being respected. There's no necessity for it to trade back down into this area. So that will be a what? A breakaway gap. That indicates that we're going to see continuous upside delivery, and it's going to draw towards the buy side. That's the next significant pool of liquidity. So if you're an overnight session trader, say you want to trade in Asia, say you want to trade in London, you're using these ideas in conjunction with the day and time that you're trading. So where's the liquidity? The liquidity is not changing because you're trading in Asia. The liquidity is not hiding itself because you're in the London session. Liquidity is there, and it's going to gravitate towards that level. But I want to take you, before we go any further here, I want to take you back into this area here. Focus on this little segment of price action right there. Do you see anything that stands out? We're going to focus on this little area. And why am I focusing on this area here that's shaded in? From this high down to that low, and then how we start to deliver going back up. Because the trust is that there's no necessity to go back down into this area, which is a breakaway gap. Because this line here is your bullish breaker. Everything is indicating that order flow is supporting that idea. So watch this shaded area. This is the 5-minute chart. Now we're going to transition into a 4-minute. Notice any changes here. Now we'll look at the 3-minute chart. It's a 2-minute chart, same range, but it looks different, doesn't it? And then finally down to the 1-minute chart. Now, this green line here, again, is the hourly bullish breaker, that high. We dig into it here 1, 2, 3 times, and then we have a swing high broken to the upside. The last down close candle prior to that shift in market structure, that down close candle is a bullish order block. That opening price is a change in the state of delivery. The change in the state of delivery is when that candlestick's opening price is crossed right there for the first time. When that happens, then and only then, never before, never another time in the future, that validates this down close candle as a bullish order block. Now, why? What makes that an order block? The fact that we have this bullish hourly breaker, the fact that we traded down into it, and then we see a shift in market structure. Then we go back to the down close candle, the last one, prior to a run higher that has a shift in market structure there. I don't care if this candle started here, it opened here and went down, or if it opened here and went down. I would draw it right on the opening price. This becomes a bullish order block as soon as that candle crosses it, the opening price. That's the change in the state of delivery. As soon as that occurs, this low should not be violated. So you can now start looking for bullish PD arrays that are in discount. Well, everything's in a discount now because we're so far down. But we have a down close candle right here. So we can use that opening price, extend it forward. Anything in there, buying this, anywhere in this area here, buying that, you can buy that with a stop loss right below there. But look closer. We are now looking at that price range from this high up here all the way down to that low. We trust that that low will not be violated. Why? Because this candlestick was crossed right there. Now what happens, let's play devil's advocate, what happens if it breaks that low? Okay, then you have to continuously study price action and wait for that same instances where we see a shift in market structure to the upside. In the last down close candle, we'll mark the opening price, and if there's a candle that goes above it, that validates the down close candle as a bullish order block. This is only one form of my bullish order block. So we have the ranges here. 75% of the range is a gradient, 50%, and then 25%. So I want you to notice how as price works very close to the 25% of that range, again, the range is the high to that low, we are trusting that it wants to go higher now because we have a change in the state of delivery. When that candle starts moving above that opening price, now we have it. It's in place. We have a shift in market structure. All lights are green for going higher. Look at price. Order flow. What kind of order flow? Institutional order flow. Easiest, right to the chase, no bones bones about it. Easiest thing is if we're bullish, we want to see down close candles support price. If we see a short-term low taken out, we expect to see that as a stop run, and then price should revert right back into going higher right away. And everything I just said, reverse it for when the markets are bearish. We have a down close candle here. Draw it out in time. Does price support at that level? Yes. 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 Does it start moving higher? Yes. Does it take out short-term highs? Yes. Yes. Down close candle. Is price supporting it as a bullish order block? Yes. It's not going below it. Does price go higher and take out high? Yes, it does. We have a down close candle. Does price go down into it and reject that area and leave it and break a high? Yes. Down close candles here. Why am I picking this one? Because it's above this high here and this high here. So does it support price? Look at it. What happens when it hits it? Starts going higher. Does it take out a short-term high? Yes, it does. So is order flow bullish or bearish? It's bullish. What is it reaching for? A premium. Relative to what? The range, which is this high to that low. That is determined by this level here, which is equilibrium. At that level or below it is what? Discount. At that level or above is what? Premium. So when we get above this 50% level, it's far less probability, more risk if we start taking order blocks and buying them above this level because we're in the premium range of this high to low. Doesn't mean it can't keep rallying. It just means that we have to do all of our buying below equilibrium or less while we're in a discount. That's the framework for high probability. Short-term lows being taken out, we expect that to be rejected and start seeing price go higher. We start to see it run higher here. Does it find support on this down close candle here? Yes. Sends it higher. Does it take out a short-term high? Yes and yes. We have a down close candle here, right around equilibrium. No return back to it here. That's fine because we're in that area where it's a short-term premium. Down close candle here. Look at the body supporting that idea and then rallies higher. Highs are taken out. Down close candle, does it support it as bullish? Yes. So when I'm watching price and I'm on side and I'm expecting prices to go higher, I'm looking at every down close candle as a means or mechanism to support price, or any swing low is a potential stop run. So I'm not in a hurry if I'm long to ram my stop loss between some random swing low, because that's exactly what the algorithm is going to do. It's going to sweep below them like it does here, like it does here, and like it does here. And then once it does that around equilibrium, then it's going to go into another price leg higher. And then we enter a consolidation. What's below here? Sell stops. Now we can go higher. Notice also that we have all of these fair value gaps. When we have a change in the state of delivery and we enter a buy program, which is where we are from this point on there. Well, what's going on here, Michael? It's just retracing. That's all it's doing. It's allowing for a deeper discount with that low staying intact. When this high is taken out here, notice that we have another return back into this order block. When we have this retracing back in the order block here, that's when we start seeing the more pronounced run higher. But look what's occurring here. All of this imbalance here, what is it lacking? Buy side delivery, not liquidity, buy side deliveries when there is a run higher in price. Look what it's doing. It runs higher. Look at the bodies respecting what? The inefficiency's high right there. This SIBI, that candle's low. What is it respecting? This candle's low. Now what is it dropping down into? Consequent encroachment, midpoint of this candle's low and this candle's high. There. Rallies. Where's it rally to? The fair value gap right here. So how do we use this information? They're inversion fair value gaps. These are like a mountain climber, and the mountain climber is climbing up the surface of the mountain, and he's looking for those little pockets to stick his fingers into and stick his toes on to find footing and grasp a new finger point or holding point. This is the mountainside here. And this is the most sheer drop off. So this is the smoothest part in that drop off. So we have to use these areas to find what? Footing. There's little pockets. We have to wait for them to form. That means consequent encroachment, short-term low, trades below. What's it going to do? Trade back into this order block and take out that short-term low for sell stops. I want to see it react at that order block, and then also that it's taken out liquidity, and there's also a volume imbalance right there. So fair value gaps like this, if we're bearish, we expect it to go up there and sell off. But when there's a change in the state of delivery, we expect the market to go up. So all these down movements here, it's lacking what? Buy side delivery. So it's going to want to gravitate up into them. If it ever retraces into them, once it closes them in, we treat them as what? Inversion fair value gaps. So we see this consequent encroachment, which is midpoint of the shaded area, midpoint between this low and this high. Here, we rally up to what? This gap. We're treating it as an inversion fair value gap. Does that mean it's going to trade right here and go higher right from there? No, we have to wait and watch. What is this here? This is a buy side imbalance, sell side inefficiency. What is this right here? It's a swing low. We've had a nice move outside of the range of these relative equal highs, and we're into two inefficiencies, this one and this one. And now we have a short-term low. It's probable, not guaranteed, it's probable that it's going to run for short-term sell side liquidity. Stop hunt. That's what we're getting from here. It drops down, takes out that liquidity, also respecting consequent encroachment of this fair value gap, then rallies. It rallies to this high and through this inversion fair value gap, comes back down, support, rallies back up. What is it creating? Short-term low. So what's going to be trailed up right behind that? Sell side. Where are we at in the range Here's equilibrium. We're right there at equilibrium. When this occurs, equilibrium is where you're going to anticipate, you're going to predict, you're going to expect a stop hunt. That's what the algorithm will do. A run on stops. This one is 2 times, but returning back into what? This fair value gap, which is an inversion fair value gap. You would take this, extend it over. What is it respecting? This order block still, that's a reclaimed order block, but it's also in concert with this candlestick's low. It's respecting that old gap. So that makes this an entry off of what? This inversion fair value gap right here. The market finds support here, rallies, takes out the high, and trades up into what? The next gap over here, which will be treated as what? An inversion fair value gap. When we drop down, we're taking out sell side here, and we're doing what? We're rallying off of the low of this fair value gap. So this candlestick's high, that's what we're respecting over there. Look at the bodies. It's telling you the story. It's supporting the idea that that is still the underlying narrative. Stops have been taken, control mechanisms are in place. The algorithm is absolutely respecting that old fair value gap right here. Rallies, order block, touch it. Does it rally higher? Yes. Does it take out a high? Yep. It's liquidity and inefficiency. It's discount and premium, time of day. All these things come together to make a beautiful tapestry, and you're never surprised, and you're waiting for them to form. All right, so here is the back on the 15-minute time frame. So what happens once we clear this balanced price range here? Remember, we hit the bullish breaker line here. We have all these inefficiencies in here. What happens when we get above it? What can we do now? Well, we have a target up here. That's a draw on liquidity, and then we have now this old market structure high. So now we can take that range and draw a fib from that high up to this target. Now we have gradients. So now we're grading a future price swing that has not happened yet. As soon as this candlestick right here closes, now we run from high to target, and we run gradients. And now watch what happens. Around the I have it backwards here. 75% or the lower 25% of the range between the draw on liquidity and the high that was broken. We don't think that the market's going to go down here. Why? Because this is a balanced price range. So we have relative equal lows, and they sweep that. Where does that occur? In the lower quadrant of the range from this high up to that draw on liquidity, which is the weekly mitigation block. Then we have consolidation. Where does consolidation form, ICT? At equilibrium, 50% level right here. That's where consolidation is forming. And then what happens? A stop hunt. Lower time frames, look in there, you'll see it. Rallies up. Another time here. And what happens here? At the upper quadrant, from the draw on liquidity to this high, we're anticipating new price points that surge higher. We rally up, then we take out the liquidity above that weekly mitigation block. And then we consolidate going into Friday, New York session. This is a 15-minute time frame on Friday, and we're consolidating. Markets do not top like this, folks, especially ahead of news drivers. We've consolidated, we're part of a bullish run, and we're expecting capitulation to come in. And that's what we're seeing here. Market rallies aggressively. What are we seeing here? See this gap right there? Extend that through. That's what you're seeing. That's an inversion fair value gap. Explosive run to the upside, retracement, failed to run higher, back down into the sell side here for a TGIF trade. 5-minute chart on the NASDAQ. Here's that price run here. Then we have this buy side imbalance, sell side inefficiency. Then we run up, we have a blow off move, and then we break down. Where's the fair value gap in here? There isn't one in here. Not on this side of the curve. The curve is here and then down. So you have to use the imbalance on the left side. That's going to be an inversion fair value gap. Extend that through all the price action. That's what you're seeing here. And then you have a small little fair value gap. Trades up into it here. Then we break. This area here is a breakaway gap. We want to see it stay open. So why should it become a breakaway gap? Because we have had a shift in market structure there. We have a buy side imbalance, sell side inefficiency. Relative equal lows, blow off move after the market has been going straight up all week as we were expecting it to. And then we have the inversion fair value gap. Is it respecting that? Yep. And then we break below the short-term low here, below this short-term low here. And where's liquidity at? Below here, sell side. But then we have this buy side imbalance, sell side inefficiency. So any rally from this candlestick open up into above this high, we want to see it stay open. What happens if it closes in? It's okay. I would still want to take a short up there if I was watching live and the market breaks down. Doesn't get below the what? The bodies. So we still have this wick to contend with. So we retrace higher, up close candles consecutively. That's a bearish order block. Breaks down through it, extend the opening price over there. That's a change in the state of delivery. Returns back into it here. And all of this consolidation is time distortion. It's not time for the market to do anything. It's not going to do it. It's already ran the low here, which is the lunch macro for New York. It's already did that, but we're not done. We have TGIF. It's Friday. It's likely to do what? 20 to 30% of the weekly range in terms of a retracement from the high of the week. Where's the high of the week? Over here. When can we trust that's the high of the week? When we see this element here, and then we start seeing everything start breaking down. This high is intact. But what happens if it runs up and goes higher? Then you're wrong. How's that for logic? You're going to get it wrong sometimes. What time does time distortion stop? What did I teach you? Post New York lunch, we start seeing 2 o'clock to 4 o'clock. That's your PM session time. Then all of a sudden, what happens? The market delivers a run through low, lower low, fair value gap, trades up into it, consequent encroachment of the low on this wick, sells off, hits the sell side liquidity, and trades to the 20% level of the weekly candlestick. So from the high to the low, measure that, and it retraces 20% of the weekly range in here. And here's a 1 minute chart of that time of day. Here's the PM session. So here's the lower quadrant, or 25% of the range that's shaded here. So here's the high, 75% of that range, 50% of that range, 25% of that range, and the low of it. Right away, this should jump off at you. That's a breakaway gap. Why? Why should that be a breakaway gap? Because we are under time distortion. That means all of this back and forth price action is just marking time. That's the benefit of knowing how to use a time-based chart. I'm waiting for time. When does it start? Right there, 2 o'clock in the afternoon, New York local time, because the market is driven by an algorithm. There's a time for everything, a beginning and an end, a pause, a consolidation, and distortion, where everything you try to do will chop you up. So you wait for what? 2 o'clock, and then wait for displacement. What does that look like? Right here, takes out that short-term low, boom. But now we have what? We're late in the day. This shaded area here is the buy side and balance, sell side efficiency. We have moved away from the high, and we moved aggressively away from the 75%, upper 75% range of this shaded area. So I don't want to see this area come back into. I don't want to see it come back up and trade into that. But if it does, I would treat it as an institutional order flow entry drill. In other words, a partial entry and then sell off. Either way, it makes it a breakaway gap. So we don't want to see it trade back up above 50% or consequent encroachment of this shaded area here. And now we enter into another time of day, the 250 to 310 macro. My algorithm starts at 250 to 310 and will start spooling price, running for the liquidity that has not been purged yet. What is that liquidity? The liquidity below the lows, the 7 a.m. New York session time, the 8:30 lows, the 9:30 to 11 lows. All of that is the draw on liquidity, and or in this case 20% of the weekly range. That would be anywhere in this area here. But we start to see this energetic price run, aggressive dropping lower. That's algorithmic. This right here, just like I talked about earlier, when we ran up, you can use the fair value gap on the left side of the curve, and we're seeing that happen right there. Then it breaks. This is a measuring gap. We don't want to see that filled in, just like we don't want to see that. What makes this a measuring gap? Well, between this high down to this low, we're expecting that run, and about halfway, we're expecting a gap to form. When it does, and it moves away from it, we are not expecting it to come back into that. That's a measuring gap. You have to know where the market's likely to draw to. Breakaway gaps are just gaps when you want to see an energetic price run away from an area you anticipated prior to it running away. So you're expecting it to move lower? Great. When it finally does, and it creates a gap like this, your first thought should be, okay, the first fair value gap after it starts to run, that should be a breakaway gap. We want to see that, especially if we've been in consolidation or experiencing time distortion. Time distortion is simply a matter of time between segments of time of the day where markets will start spooling. That's it.